What's up, guys? Welcome back to Everyday Money. Anytime folks start talking about mortgages, there's always comes up of what to do with it. Should you pay it off early? Should you take it completely to term? How much interest could you possibly be saving? And there's a lot of folks out there that want to get their mortgage paid off as soon as possible. They want to save that interest money. They are the Dave Ramseyites out there who are the debt-free folks who say never, ever, ever have debt. Even if it's low interest, fixed rate debt that's below the rate of inflation, get that stuff paid off as soon as physically possible. And then there's the other side of the coin, the folks that are saying just pay that note, pay off that interest over time, but invest that money because you're going to end up way farther ahead in the future. And so what I'm going to do today is give you guys 4 million reasons why I am not going to pay off my mortgage versus investing that money, and why I think that paying off your mortgage early, if you have the opportunity, is a bad idea. So if you guys can give me a big thumbs up, hit that like button down below for the YouTube algorithm, we are going to get right into it. Now, guys, this is the classic save versus invest type of situation. And most people out there, they want to save money. They want to try to reduce the amount that they owe versus trying to make more money, trying to make more money with the money that they have. So if you're fortunate enough to save up the amount of money where you can pay off your mortgage note, that you come to a crossroads of what you do with that money, because everybody out there is telling you that you need to pay off that mortgage, pay it off, pay it off, pay it off all the time. And so what I want to do today is I'm going to look at my mortgage. This is my actual mortgage that I have on my home, and I could probably come up with the money to pay it off if I move some stuff around. So what I am looking at for my home is a mortgage amount of $228,000. I have that financed for the typical 30-year term at 2.875%. It's a very good interest rate. And if you guys haven't refinanced your interest rates yet and you're up into the 3s or 4s, now is the time to do that, because the Fed is raising the federal funds rate in the coming 2 or 3 years, and so mortgage rates will be going up. With that amount of money financed over 30 years at 2.875%, I am looking at paying a total of $113,000 in interest. And I know that you savers out there are going like, oh my God, $113,000 in interest? That's ridiculous. If you can pay it off, you need to do that so you can save that $113,000 of interest. But the numbers that I'm about ready to hit you with are going to hopefully change your way of thinking on this, and you guys probably already know which way I'm going with this. The amount that you would make if you would invest this money into a low-cost index fund or some other investment, and you can come up with whatever investment that you want, but the one that we're going to use today is buying a total U.S. market index fund, a low-cost index fund, very easy to get into, to get out of, has very predictable returns, and it's just very easy for folks to use. Returns about 10% every single year on average. And so if we invest that $228,000 into this index fund for the 30-year term of the loan at 10%, we end up getting a value of $3,978,463.72 at the end of that 30-year period. If you look at that return that you're going to get there versus saving $113,000 in interest fees, I mean, it's a no-brainer to me. I'm going to take that money, I'm going to invest it into the markets and have $4 million versus saving $113,000. That is a simply no-brainer to me. The thing is that if you take that money and you invest it in this account anyhow, even if you don't want this $4 million at the end, which, why wouldn't you? But if you invest that money, just the returns that you make every single year would make your mortgage essentially paid off. And I know that you're thinking like, well, how could that possibly be the case? Every year this returns about 10%. And so you are going to be getting about $22,800 every year in returns on this money that you have invested. Now, for me personally, my entire mortgage payment, including principal, interest, insurance, and taxes, is about $1,350 a month, or $16,200 a year. When you look at that versus the $22,800 every single year that I would be getting from my investment returns, you can see that I can essentially pay this note forever, including my taxes and insurance, on this $228,000 invested. You can probably do the math really quick like I did and see that you are still left over with $6,600 every single year, even if you pay your mortgage out of the returns for that. So if you just leave that money invested and you reinvest that $6,600, at the end of that 30-year term, it would still compound up to $1.3 million, actually just a little bit over $1.3 million. So again, you could have your mortgage essentially paid for with that $228,000 invested and using the money that it throws off every single year and still end up making almost 10 times what you would have saved on your interest savings by paying off that mortgage right now. The argument that a lot of folks have for paying off their mortgage right now as fast as possible is that it feels safe. They feel safe that they don't have that mortgage payment, but they couldn't be any farther from the truth. For one, if you have $228,000 saved up in your account, in your investment account, and you cash that out and you pay off that mortgage, you now have $0 for anything that comes along down the road. For example, if you need a new roof, if you need a sewer line replaced, if you need a new air conditioner, if you have a health scare, you need to purchase a vehicle, anything really, you are starting back at zero. Now, of course, you do have that money in your house as equity, but it is going to take some means to access that, like a home equity line of credit, a cash out refinance. Then you're back on the mortgage train again, and you've pretty much undone everything that you have done. So you are giving up a lot of safety of having a lot of money just ready to deploy at any time to pay off that mortgage. In addition to that, you are going to always have taxes. There are two things that are certain in life, and that is death and taxes. The property tax bill will always be coming for most people out there. Some people it's going to be a lot of money. Some people it's going to be a very little amount of money. For me, it's about $250 a year, a month for about $3,000 a year. But that is a payment that is always going to come along. In addition to things like maintenance and repairs and just stuff that you have to do to a home that it would be nicer to have that money sitting there ready to deploy at a moment's notice versus locked in your home as home equity. So why do people end up doing this? Why do they pay off their mortgage versus investing it if it's clear by the math that you are going to end up way ahead by investing your money versus paying off your mortgage? The thing is that it just feels good. And that is a thing that leads a lot of people astray in investing in anything, be it real estate, stocks, crypto, in a business or something, is that a lot of times feelings get in the way, and the way that you feel doesn't necessarily jive with the real life conditions and the real life results that you would get by just staying the course. So I think it's important that if you're fortunate enough to have the amount of money to pay off your mortgage, to write down on paper exactly what your returns would be if you would just put that in the market versus the false security of having that home paid off. And you can see that that paying off your mortgage versus investing is typically a bad idea financially. Remember, guys, the sky is the limit for earning more through either jobs, side hustles, passive income, investments, things of that nature. There is no upward limit to how much money that you can earn every single year. However, there is a finite amount that you can save and cut. And this is one of those examples where you can save your way into mediocrity, into middle class or whatever, or you can invest your way into wealth, into financial freedom. I mean, I think anyone would be pretty much financially free that has a $228,000 mortgage with $4 million in 30 years. That's probably going to get you some pretty awesome financial freedom when you're in your 60s and 70s, and really increasing your income through working more may not be something that's available to you. So guys, if you like this video, give it a big thumbs up. Leave me your comments down below. Am I right for saying that you shouldn't pay off your mortgage versus investing it? Or are you guys completely in agreement with me that investing your money and letting it grow to massive amounts is the better way to go? Because the thing is, really, once you get up to $2 million or something like that, you're sort of into that FU money area where you can pretty much do what you want. And so if you've paid this off down to $150,000 or something like that, then you can just go ahead and just, if you want pay it off then, because you have so much extra money that it's not even that big of a deal, and your money will still compound to gigantic proportions. So guys, I appreciate you guys watching today. If you haven't subscribed, subscribe down below. Hit the notification bell so you don't miss anything else that I put out on personal finance. Again, I appreciate you guys watching. I'll see you in the next one.